All right, hi, welcome back. Tonight we're talking about debt. Everyone loves to talk about debt. So if you have any questions, please give us a call at 613-728-1001. We have 3 experts here looking to answer any of your questions. So my question, we'll start with Tom. What are some of the kind of major warning signs when someone should say, you know, I need to get help?
Yeah, so one big one is if you're getting calls from your creditors. So, you know, that's a little bit far down the line, but it's what a lot of people run into. It can be just a call about a late payment. It can be a call from a collection agency. And whenever you're getting a call like that, it definitely warrants a time to look at the situation. I mean, a lot of times you can have the mentality where you don't want to address it, you're afraid of what you can say, and you might not know where to turn, but that's exactly the time when you do want to speak up and look in your options, whether it's talking directly with them or a professional.
And what are some of the options for somebody a client that you're dealing with? What are the options you generally kind of present to them?
There's a variety. So the first one generally we talk about is, you know, have you spoken to your creditor, your financial institution, your bank about the issue? You know, a lot of times people don't think there's anything they'll be able to do, and there actually can be. If you're at a point where you haven't fallen behind on payments yet, they might be able to consolidate, maybe transfer you to a lower interest product at a better payment so you can make a bit more headway on your debt. Even if you're behind on payments. It's not known, but a lot of banks do have financial hardship programs. TD is an example. They have a program called TD Helps. And even if you're behind on your payments, they'll consolidate their debts together and put it into a more manageable payment and get you back on track. So it never hurts to talk to them. That's definitely the first place to start. And then it's going outside the box. Have you looked at your budget? Have you talked to your family? Is anyone in a position to help? Do you have anything you can sell? And then you can get into some other options like debt management programs, consumer proposals, and bankruptcies. And that's where you can look at other alternatives when you've exhausted the options of dealing with it on your own.
Okay. And Troy, for you and your position, is there different options that you...
We typically will look at all those options. One of the ones that we also look at is doing informal negotiation. So sometimes the individuals will either get help from their family, they might have some money set aside, and if it's in a position where that debt's now fallen into a collection agency where it's gone from the bank has now written off that debt, the collection agency is trying to collect on it, it's an opportunity to then, you know, deal with that collection agency and negotiate a settlement. So in doing so, it doesn't have any more negative effect on your credit rating nor positive, but you know, if you don't have to pay it back in full and you could pay it back at 50 cents on the dollar or 30 cents on the dollar, then there's a savings there to the consumer and that debt then gets closed. So those are some of the other options that we can look at, definitely, if they're running into trouble.
And we touched on this earlier about self-employed. I know rules in terms of mortgages, they've changed, haven't they, regarding self-employed?
Yeah, it's a lot harder than it was before. Roughly 20% of Canadians are self-employed in one way or another, part-time or full-time, but the government kind of is making it harder and harder to qualify for a mortgage. So right now, if you want to get, you know, excellent rates, you need to have at least a very high credit score, and then like you need to, the way that they qualify for the income is a lot harder than it was before. So it's even more important than it was before. Like before, you could just kind of walk in and say, hey, I make this much money in my bank, you know, and they would just stamp it and you'd have a mortgage. But now it's a lot harder and you need to show a lot more documents. And if you don't, if your credit's not as good, then right there you have to have at least 15% down just to get in the door. So it's a lot harder.
Okay. And what kind of like how long do they look back for self-employed, like history?
They like to see, depending on how far it went, but most banks like to see 2 years of clean credit. So 2 years of clean credit, and you have to have trade lines on there, 2 trade lines. So 2 credit cards or a car loan and a credit card.
And like we were mentioning before, a great strategy is if you know you're self-employed, you're thinking about home ownership, get involved with a mortgage broker early and make sure you understand what is required, so that as you go through and do that, when you are ready to buy that house, you have everything in order. So if you wait until you have that deposit, you know, you call the mortgage broker and then you find out all of these documents are required, your score has some issues, you're really another 2 years away or possibly a year away until you can get everything fixed up, right?
And even if your credit is excellent, because of the new rules, you might decide you're going to claim a little bit more income on your income tax, because usually people that are self-employed, they try to write off as much income as they can to lower their line 150 on their notice of assessment, and they go get a mortgage, and they're like, well, it says you only make $20,000, but we know that they make more, so then you know, so you maybe pay a little bit more on income tax, you can get an excellent mortgage rate.
Yeah, that's one thing I was going to bring up too. Dealing with some self-employed individuals is that, you know, they have those business expenses, so they know that they're bringing in this X amount of dollars, but then when they were, you know, their actual total income, and then they kind of scratch their head and go, well, you know, and that's why I think it's a good point to get involved earlier in the process to know where you have to get to, instead of just being that big surprise. You know, I'm going to buy a house and then I'll wait.
Because if you claim enough income, you can qualify for the same mortgage products as someone who's on a salary.
Exactly.
So. And especially if you're self-employed and you have an accountant. So, you know, again, as part of that plan, make sure your accountant is aware of what's going on. So, you know, a lot of self-employed individuals that are busy and they're successful, they say, oh, well, my accountant deals with that, so I'm not too worried about it. And then they realize that maybe they've been paid dividends, which is different than, you know, reported income, and that could change how you qualify for a mortgage. Or they write everything off, and again, as mentioned, they show $20,000 a year, but the actual cash flow could be a lot higher than that.
Exactly. And that's why anyone that's self-employed should get a good financial advisor, hint, hint, and
absolutely.
You know, plan these things out, right? It's again, it comes down to planning, and
why guess when you don't have to, right?
Exactly.
There's a lot of misinformation on the internet. You can try and do research, but it never hurts to get the advice of a professional and make sure you're doing it the right way.
Someone who does it full time probably knows more than you looking on the internet, right?
Exactly. And someone to be able to answer your questions about, you know, each situation is unique, especially with mortgages. So, and yeah, getting the right answer for your situation is always a key point. So, I think you hear the word bankruptcy a lot. What exactly, Troy, does bankruptcy mean?
So so bankruptcy is something that's done under the Bankruptcy and Insolvency Act.
Right.
Trustees do that. So trustees, they call them trustees in bankruptcy, and it's done as a way for an individual debtor to seek protection from their creditors. So a lot of people think if you go bankrupt, it's free. It's not. You still have to pay the trustee to go through that process. You also have a number of requirements that you are supposed to do as part of the bankruptcy, or you don't get discharged.
Right.
So typically that would be 2 counseling sessions. Depending on how long your bankruptcy is. Your first time bankrupt, you'd have to fill out 9 income and expense reports, and you're going to have to pay the trustee. So the amount of money that you're going to pay him will be based on surplus income, and it would be based on any assets that you would have which wouldn't be exempt. So in Ontario, as an example, equity, there's no equity available in the home. So if you have even $10,000 worth of equity, that equity is available to your creditors in a bankruptcy. So understanding what those rules are an important step in making sure that you do understand what you're doing when you file an assignment into bankruptcy.
Okay.
Yeah.
And Tom, another same line, like consumer proposal.
Yeah, a little bit less known than bankruptcy, but still under that Bankruptcy and Insolvency Act that Troy just mentioned. So a lot of times it's seen as an alternative. It's a way on getting your creditors to settle your unsecured accounts without going through a full-fledged bankruptcy.
Right.
A lot of homeowners and people with some equity and assets trend towards a little bit more because it gives you some availability to keep it. But essentially they structure your debt at no interest over a 5-year repayment term for a balance. It is still a fairly hard hit from a credit rating standpoint because you are going under the Bankruptcy and Insolvency Act. But some people like using it as an alternative. Another option that's sometimes used is a debt management program. That's an arrangement that's worked outside of the Insolvency Act with your creditors. It's a way to still pay back the debt in full, so still honoring the full debt that you owe. They get assistance with the interest rates, payment sizes, and consolidation. So there's definitely alternatives to bankruptcy. Bankruptcy is needed in many cases, and I don't want to talk down in full about bankruptcy because many times it is the best option. Lots of people we'll meet with, it's the way we're going to recommend. It's just important that you understand the consequences, like Troy mentioned, and make sure that you've looked into your alternatives first, because once you're in, and it's going to be a long-term impact that you're going to be getting yourself into.
And I think it comes back to, it's an excellent point, I think it really comes back to when you decide that you want to start dealing with your debt. So you know, what we've found is that individuals will pay the minimum payments for 3 years or longer before they ever call into one of our offices. And we always ask them, how much money do you think you've paid to your creditors over those last 3 years? You've reduced nothing on your balances, and now you've come into the office and you have no other choice. So if you know there's a problem, the best thing to do is to actually start now.
Yep.
Part of that planning process gives you more options. It allows you to have more control over what's happening and to avoid a bankruptcy if that's what you feel that the individual needs to do in order to deal with their debt.
Right. And speaking of credit ratings, obviously in a mortgage agent deal with credit ratings. Can you tell how important is a good credit rating?
Well, I think it's really excellent.
Yeah.
The better your credit rating, the more lenders are going to want to lend you money.
Right.
The more money they're going to want to lend you, and the less you're going to pay for that money.
Right.
So it's very important.
And what would be considered like an excellent credit score?
And 700 and up
700?
usually now.
And so someone that declares like a bankruptcy or a consumer proposal, how long does that really affect their credit rating? Does it?
From the time they're discharged,
Yeah.
same thing, it's 2 years for them to have reestablished credit. So if they got discharged, but then they're like, I'm not using debt ever again, I'm not getting a credit card,
Yeah.
and they come see me, I'm like, well, pretty much it's the same as having bad credit because you have no credit. So it's important to get maybe even a secured credit card or something, just not too big, just to get you
Right.
started. And usually the lenders look at consumer proposal and a bankruptcy the same thing. It's
Yeah.
just pretty much seen as the same thing,
Yeah.
just one you kind of paid it back and the other one you went bankrupt, but that's something to keep in mind. And also it's, some people, there's the help they get, like it's bad to go bankrupt for a very small amount too. The lenders see that very negatively. Like let's say I've had clients where they went bankrupt for $15,000. So then the lender is like, I wouldn't want to lend to this guy.
Right. The risk is too
He
big.
went bankrupt for $15,000. What's he going to do when he has a mortgage, right? So it's important to weigh your options and get good advice.
And the fact of the matter is the bankruptcy stays on your credit report from the date of discharge for 7 years on your first
Right.
bankruptcy. And from your second one, it goes to 14 years. So it is a long term that it's still visible by your creditors, and it's something you need to be aware of. A proposal, you're to go through that. Generally, again, it's that 5 years of payments. But upon the completion, it's an additional 3 years that information is going to stay on your credit report. So you do have to understand that what you're getting into is going to remain for a while. But at the same time, I think sometimes we do get too tied up with our credit rating. And I mean, sometimes we're doing everything we can to protect our credit rating at a time where it's not our biggest necessity. I know people who are striving and digging to make minimum payments to keep the debt where it's at and years are passing. And sometimes you have to take that time, deal with your debt, and rebuild the credit. It can be rebuilt. There's lots of options, like was just mentioned, about secured credit cards and ways in building it back, but you can't fall in love too much in some cases, as important as it is with your credit rating.
And even if your credit card's maxed out, they're all maxed out, your credit is going down anyways. So even if you're making your minimum payment.
Another quick thing is there's no quick fix either too to rebuild your credit. That's something I've come into frequent. People expect it to be fixed tomorrow, right? I could just hit enter on my computer and it's fixed. So with that, we're going to go to break and we'll be right back.